For the passive loss rules, your first job is classification. On the EA exam, they'll hand you income and losses and ask what bucket it goes in. Think 3 buckets: active, passive activity, and portfolio. The bucket matters because passive losses usually cannot offset active income like wages, or portfolio income like interest and dividends. Get the bucket wrong, and the limitation answer is wrong. Passive activity income is a Section 469 concept. A trade or business is passive if you do not materially participate. Rentals are the other big category. Rental real estate is generally passive even if you're involved. That's why the exam loves limited partners and rental owners with day jobs. They look passive in plain English, but the test is the tax definition. Don't mix up active participation and material participation. Active participation is a lighter standard used in some rental real estate exceptions, but it does not convert a rental into non-passive by itself. Material participation is the heavier standard used to decide whether a business activity is passive. On the EA exam, if you see limited partner and no involvement, assume passive unless facts clearly show material participation. Here's the big trap. Lots of items that feel passive are specifically excluded from passive activity income. Portfolio income is the classic one: interest, dividends, annuities, and many royalties. Personal service income is also excluded: wages, commissions, Schedule C earnings, and guaranteed payments for services. So even if you didn't work for it, the code may still force it into portfolio or active, not passive activity. A few more exclusions show up in tricky questions. Royalties can be passive activity income only when they're derived in the ordinary course of a trade or business. Otherwise, they're portfolio. Cancellation of debt income is another odd one. It's passive only if, at discharge, the debt is allocated to a passive activity. The exam may also toss in state tax refunds or a covenant not to compete payment. Those are excluded from passive activity income by definition. Now, connect classification to the limitation. Passive losses generally offset only passive income. If passive losses exceed passive income, the excess is suspended and carried forward. But there's a key release valve. If you fully dispose of your entire interest in a passive activity in a taxable transaction to an unrelated party, the suspended losses are freed up in that year. On the EA exam, that fact pattern is a giveaway. Finally, rentals have 2 common escape hatches. One is real estate professional status, which can make rental losses non-passive if you materially participate. The other is when a so-called rental is really a service business, like a short-term hotel-style rental with substantial services. Then it's reported like a business, often on Schedule C. On the exam, watch for daily cleaning, meals, linens, and stays capped at short periods. Marissa is an 8% limited partner in a partnership and doesn't participate. She's only an investor. Over prior years, she built up $18,000 of suspended passive losses from that activity. This year, she sells her entire partnership interest to an unrelated party and stops being a partner. What happens to those suspended passive losses on her individual return? Think about it. The correct answer is, she may deduct the suspended losses in the year of disposition. A fully taxable disposition of her entire interest to an unrelated party releases the suspended passive losses. A tempting wrong choice is the idea that she must wait for other passive income, but that's only when she still owns the activity and the losses remain suspended. Here's a real estate professional threshold question for a closely held corporation. It can qualify as a real estate professional if more than what percentage of its gross receipts for the year came from real property trades or businesses in which it materially participated. The choices include 50, 90, 40, and 80%. Think about it. The answer is more than 50%. For a closely held corporation, over half of its gross receipts must come from real property trades or businesses where it materially participated to qualify under this rule. The 90% option is tempting because it sounds like a stricter test, but the exam threshold here is the more than 50% line.